Chapter 6. So today we're going to talk about our long-term operational assets, which encompasses property, plant, and equipment, as well as intangible assets. Thinking back to that ridiculous example of the apple tree, we got our capital and we used it to purchase infrastructure, which would then allow us to generate revenues over multiple periods, perhaps as many as 40 or 50. Take DP Corbett Business Building. We spent a bunch of money on DPC, and when we credited cash, we decided that we should debit an asset rather than an expense, so that our income statement would be more meaningful both this year and in the future. So why is it we're doing this capitalization process? It comes down to our friend matching again. We're trying to match costs with the revenues that those costs make possible. Now, what sorts of assets are we capitalizing when we talk about these long-term capital assets? Some are certainly obvious. We've got our land and our buildings, of course. We've got equipment. If we've got a factory, it's full of machinery that's going to be chugging away producing product. There are other things that you might not have thought of, though. Here we are in the state of Maine, and in addition to tourism and meth, what do? We chop down trees. And so if we're buying timberland, we're going to capitalize that since we'll be chopping down trees over a long period of time. In fact, now with the advent of sustainable timbering, it's conceivable that we'll be chopping down trees out of the same forest virtually forever. If we have a mine that we're going to be extracting ore from, or an oil field, we'll treat those the same way. There's also that last category of assets, these intangible assets, which have no physical substance and yet fit the definition of an asset, namely the probable future economic benefit resulting from a past transaction. Things like, for instance, patents or copyrights. Both of these provide a monopoly to sell something. Patents let us make a product. Copyrights let us publish books or music or works of art. Here we are, the only people in the world with the right to produce something and make money off of it. You can bet that's a future economic benefit. So how do we go about booking those initial assets? Well, we already know how that works. Debit the asset and credit cash. So when we say we're going to capitalize asset costs, what exactly are we talking about? Well, first and foremost would be the purchase price, shipping, taxes, manufacturing costs if we make the product ourselves. That's certainly clear. But again, it goes beyond the obvious. Let's say we get a brand new piece of equipment that no one's ever used before, and we need to train our employees. We'll capitalize those initial training costs as well. If we have to do dry runs, run a bunch of raw materials through, knowing that when it comes out the back end it's going to be crap and we'll have to throw it away, we will capitalize that. The asset isn't generating revenue yet, so we defer those costs. In certain cases, if we are self-constructing an asset, like a building or specialty equipment, or having something made to order, we can actually capitalize the interest on the debt we use to finance the construction. This is all driving towards a rule of thumb that should be familiar from last class. All costs required to get the asset ready for service will be capitalized. So there's the big picture, what we're talking about. And then there are a number of little detail-y things that we can fiddle around with. Our first issue would be the idea of a basket purchase. And a basket purchase comes down to a simple question. How do we allocate a single purchase price to multiple assets, particularly when we are paying below market value for them? When would we do this? Well, perhaps at an estate sale or a bankruptcy liquidation, in which we would be buying not just their inventory, but also their furniture and fixtures, and perhaps even their building. So we've bought a bunch of stuff, and we need to allocate that purchase price to these assets. And here's the example where we buy land, machinery, and inventory, all with a fair value of $102,000, but we only pay $75,000 in cash. Perhaps the first inclination would be to recognize a gain, but we know that we can't do that since conservatism tells us to defer the gain until it's been realized. And so what we know is that we're going to credit cash for $75,000. We're going to also have to debit our assets for a total of $75,000 as well. So the big question is, which assets get how much? And the way that we're going to allocate this is on a proportionate basis. We're going to look at relative market value of each of these assets compared to the total amount. And we know that the land is worth a total of $35,000 out of the total of $102,000. So what we're going to do is we will give the land 35 100-seconds times $75,000, or $25,735. We will do the same thing for our machinery and our inventory. So here's our total, which sums to $75,000. It's important to note that when we say that the land is worth 35, we aren't creating assets or recognizing gains. There's our journal entry: credit cash and debit the assets in a proportionate manner. So that's a nice simple thing to think about. However, we should know, based on my Indiana house example, that things are not necessarily as simple as that. What if we've got a range of values? So here we have the same three assets, but now our market values fall into ranges rather than being specific amounts. The land could be anywhere between 30 and 45, and so on. If you think about this, this is a much more realistic scenario. How do we know how much the land is worth? Well, we know what the parcel next door sold for last year, and we know what this one sold for 3 years ago, and blah blah blah. It's going to be pretty hard to get a specific amount. For the equipment, how do you put a price on used machinery? We can go to Craigslist and look it up, but we won't find one that's exactly the same as ours. It might be a little older or a little newer. It might have sat out in the rain or been kept in a climate-controlled building. So market values are a hard number to pin down. So here we are with a range of values, and we still need to allocate that $75,000. Now here we have the opportunity to have a little fun, because there's no specific guidance on how we should pick market values. 30 is as good as 45, and it could be anywhere in between. So what do we do? Well, we could go a couple of routes. We could use the low end of our market values, so we'd use 30,000, 37,000, and 23,000, and we'd do our ratios based on $90,000. Those there total to 90. We could use perhaps the high end of the market values, and that would yield a different set of numbers. Again, we're still just allocating $75,000, not creating any asset value, only changing the way we do the allocation. Or we could pick something anywhere in the middle. I just randomly picked some, and here are the numbers we would get from those choices. Again, those sum to $75,000. So with that in mind, let's see if we can't do some fun stuff. We can use a number anywhere within there, right? These are all legitimate estimates. We're not fudging things here. Let's say we want to become profitable quickly. How can we become profitable quickly? To answer that question, we need to understand where each of these items show up on the income statement. Where does land get to the income statement? Never, right? Until we sell it. And when does the cost of machinery get into the income statement? Through depreciation over the asset's life. And when does the cost of inventory get into the income statement? Through the cost of goods sold when we find a buyer, and that is hopefully pretty soon. Now, if our goal is to become profitable quickly, it would make sense that we would want to have as little of that 75 showing up in our inventory, which we know will hit income statement as cost of goods sold in the coming year, and as much as possible to the land, which is insulated from the income statement for the foreseeable future. So here's one possible allocation, with $45,000 going to the land, there's the high value, with $23,000 going to inventory, that's the low value. In doing so, places relatively more of the $75,000 in the land account and relatively less in the inventory account. Our second scenario is tax minimization. Our goal is not to report a high net income number. What we're more interested in is maximizing after-tax cash flow, which means minimizing our taxes. This, of course, means reporting as low net income as possible, and we can achieve that by getting as much of the $75,000 into the income statement as quickly as possible. So what do? Well, we'll do the opposite. Maybe we'll choose this allocation instead, which minimizes land and maximizes inventory. Just looking at this, we can see the difference evident. There's a roughly $5,000 difference in the value that we have assigned to the inventory, and at a 40% tax rate, that means savings of $2,000 in taxes in the coming year. It's important to keep in mind that when we have these tools available to us, we're not cheating, we're not being dishonest, we're simply using the discretion we've been given to meet our company's needs. And tax minimization is a very reasonable goal for a company to have. Use the tools available. If we're looking to smooth income over time, we'd probably want relatively less here in inventory and relatively more up here in machinery and land. We could do a min-max calculation to tell us the exact amounts, but the process is the same. Use proportionate market values to allocate the out-of-pocket cost of $75,000 between the assets. The point is to recognize that we have a specific goal in mind and that we should use the tools available to us to meet those goals, rather than just picking numbers willy-nilly. Pretty cool, huh? So that's our big asset acquisition issue. There are a couple of other little minor ones. Certainly, we don't have to buy an asset for cash. We could be cash poor. Perhaps we'd issue securities instead, and that's something many of us did when we bought our home by issuing a mortgage. Here we are exchanging a security, we gave them a debt instrument, for an asset, our house. We can do the same thing for stock. We can issue stock if we want to in return for assets, and if we do, our journal entry looks the same as if we bought it with cash. We debit the asset for the amount we paid, and then we credit the stock or the debt or as the other half of the transaction. The question, of course, is what value do we assign these transactions, and our rule of thumb is fair value of the asset or the security, whichever is easier to determine. So this means if I'm Dave Co. issuing stock in my closely held company to someone, it may be easier to get an appraisal on the asset than it is to get an appraisal on my stock. But if I'm General Electric, whose stock is traded daily on exchanges all around the world, if I issue 100 shares of stock in return for something, I know exactly how much I just gave the seller, and that's the number we'll use for this entry. Our first choice would be the value of the securities, but if that's not feasible, we'll use the value of the asset. Second item, of course, is that if we receive a cash discount on our assets, like we did with our inventory purchases, we're going to treat it as a reduction in the price of the asset. We didn't get a gain because the seller knocked off 10% of the price. We simply negotiated well. And that's that. The last item is this all things to get an asset ready for use thing. This is a pretty broad statement. Let's say we buy a piece of land that has a building on it, and we plan on bulldozing it and building our own factory. Well, the land isn't ready for us to use yet, so long as that building is still sitting there. The cost of knocking it down and hauling it away needs to be capitalized as part of the land as well. So don't stop with the capitalization just because we wrote a check to the seller. There may be more involved. So there's the birth of our assets in general terms, with a little bit of detail thrown in. So we deferred those costs up front, with the plan of depreciating them over the asset's life. So let's talk about depreciation now. The first question that needs to be asked is what exactly is depreciation? Just as with our discussion of debits and credits, people typically have a preconceived notion as to what depreciation is. Generally speaking, people think of depreciation as being the opposite of appreciation. If an asset increases in value, we say it's appreciated, and therefore if an asset goes down in value, it must have depreciated. And that's not true. From an accounting standpoint, when we use the term depreciation, we are talking about the orderly allocation of capitalized cost into the income statement over the asset's useful life. We are matching. Nothing more, nothing less. Note that the definition says nothing about fair market value. It says nothing about what we could sell it for if we wanted to. It relates only to getting that initial amount that we debited as an asset expensed as we use it. We know that when we're done with the asset, the money is gone, so it's got to get expensed somehow. This then leads us to the second question, what is a useful life? If we're going to depreciate an asset over its useful life, it behooves us to know what that word means. Simply put, a useful life is the period over which we can use the asset to generate revenues. This is not how long the asset will last. Physical assets can have very long lives, but that doesn't mean they will continue to be useful to us indefinitely. An example of this would be a rental car company. The company buys a whole mess of cars for its fleet, rents them to customers for a couple of years, and then sells them on used car lots. If I'm Budget Rental Car, and I know that I'm only going to have this 2010 Ford Focus for 2 years, I have to do all the depreciation that's going to be done over that 2-year window. The car will likely last many years beyond that, depending on whether or not my brother rented that particular car, since he likes driving rental cars full speed over speed bumps. But Budget won't be renting it anymore, so their depreciation window is much shorter. An asset's physical life and an asset's useful life are more likely than not going to be different. I have down here a little table from a publication called Accounting Trends and Techniques, since accountants are oh so trendy, or techniquey, or something like that. Anyway, this is a survey that reports what companies are using for their accounting policies. You'll see that for a particular fixed asset category, there are quite wide useful lives, and this will be based on not just what the asset happens to be, but also how long that particular asset will be used by a particular company. Buildings and additions can be anywhere between 10 and 50 years. 50 is the longest period over which we're allowed to depreciate an asset. Machinery and equipment, 5 to 20, office equipment, 10, automotive equipment, 3 to 5. So there's quite a bit of variability in depreciation. We can also look at a specific footnote. This one comes from IBM's 2002 financial statements. We can see that they tell us what method they use, and we'll talk about methods in just a moment or two. They use 50 years for their buildings, 20 years for their building equipments, 20 years for their land improvements. Their plant, laboratory, and office equipment can go anywhere from 2 years to 15 years, and computer equipment anywhere from 1.5 to 5. So here we have, even within a single company, quite a bit of diversity of useful lives. And this is because the ultimate goal is to get asset costs into the income statement over its useful life. You'll note that neither the table nor the footnote reference land. Land, just as Pearl Buck wrote in The Good Earth, is eternal. Land is not depreciated. With that in mind, let's take a look at a couple of depreciation methods. There is a theoretically infinite number of depreciation methods. We aren't given any specific guidance to use one method or another. All we're told is that we should allocate our costs in some systematic and rational manner. So here are the biggies that we tend to use, though there's no reason to be limited to these two. The straight line method is the first one, and that's the one that we've already had some experience with back in Chapter 3 when we worked through the accounting system. So here's our formula, with C being the cost of our asset, SV being our salvage value, and N being the useful life. Cost minus salvage is called the depreciable base. And that's the total amount of depreciation that we're going to take over the life of this asset. We're not going to depreciate the asset for the full cost if we think that we're going to be able to recoup some of the cost at the end of the asset's life. And that's what salvage value is. At the end of the asset's life in X years, how much do I think I can sell this thing for? Let's say that we have an asset with a cost of $50,000 and an expected salvage value of $10,000. That asset has a depreciable base of $40,000, and that's going to be our total depreciation. And the reason for this is simple. Depreciation is allocation of cost into the income statement, and this asset didn't really end up costing us $50. We got our nickel back for returning the proverbial soda bottle. Remember that stable dollar assumption we talked about? Well, here it is in practice. The true cost is what we ended up being out of pocket for. So our straight line method will give us the same depreciation expense every year. So for instance, if we have a useful life of 4 years, we'll take 25% of the depreciable base as depreciation and expense each year, 25, 25, 25, 25. Those are all percentages. And make my 4 a little bit better. And at the end of the 4th year, we'll have fully depreciated the asset. So there's our first option. The other option that we like to do is the double declining balance method. Now if we parse out the name, we can see that it's made of 2 parts. The first is double, and double means 2 times the straight line rate in percentage terms. In other words, if we use that asset with a 4-year useful life above, that's 25% a year straight line. We would double that to 50%. If it's a 5-year life, we would double the 20% to 40, and so on. The second part is the declining balance part, and this refers to the net book value of the asset at the beginning of the period, which of course declines as we depreciate the asset. If we want to use the formula, it's 2 times net book value divided by useful life. Note that salvage value is not in our computation for double declining balance. Our depreciation is still limited to our depreciable base, but we will not explicitly use it in our calculation. So let's do some numbers. We have a donut hole machine because I like donut holes, and it cost us $30,000. It has an expected useful life of 5 years, and then we'll sell it to someone else for $6,000. So our first thing is our depreciable base, and our depreciable base is 30,000 minus 6 is equal to 24. And we've got a 5-year useful life, so what are we going to record for our depreciation expense in year 1? Under the straight line method, we'll take 30 minus 6 divided by 5, and that's going to give us an expense of $4,800, leaving us with a net book value of how much? a net book value of 30,000 minus 4,800, or 25,200. Note that it isn't 24,000 minus 4,800, since that 6 didn't get recorded on our balance sheet. What's going to be the expense in year 2? Of course, it'll also be 4,800, and the year after that, and the year after that, and so on, because of course that's the point of the straight line method. We get the same expense every year. Our net book value will decline each year, going to 20,400 in year 2 and 15,600 in year 3. Without doing any math, what would we expect the net book value to be at the end of year 5? At the end of the asset's life, how much depreciation should we have taken? 24,000, right? The depreciable base. So when that asset is all used up, we should find ourselves with a net book value equal to the salvage value. That's the way the math works. We should have $6,000 right here. Under our double declining balance method, we ignore that salvage value and we go straight to our calculations. Our depreciation expense will be 2 times the straight line rate, which we know is 20% times 2 is equal to 40%. And we're going to multiply it by the $30,000 of cost of net book value, and that's going to give us a depreciation expense of $12,000 in year 1. This leaves us with a net book value of $18,000 at the end of year 1. Note the difference in the reported book value at the end of the year 1 between these two methods of depreciation. Just as with inventory flow choice, our choice of depreciation method does have an effect on the financial statements, even though the underlying reality hasn't changed. Our balance sheet and our income statement are both affected. Now we come to year 2 and we have to do our depreciation expense. Once again, we take our 40% and we're going to multiply it by the beginning net book value, which in this case is the $18,000. And that's going to give us depreciation expense of $7,200 in year 2. So our depreciation expense is changing from year to year, decreasing as the net book value of the asset decreases. We'll now have a net book value of $10,800. Pause the recording and calculate depreciation expense for year 3, then restart the recording. We repeat the process in year 3. 40% times 10,800, and that's going to give us $43.20 as our depreciation expense, giving us a net book value of $64.80. Methods like the double declining balance method are considered accelerated depreciation methods, and hopefully you can see why. We have accelerated the depreciation expense, booking more up here on the asset's life in the early part than under the straight line method. We make up for it on the back end, though, as you can see that we have reversed the relationship. In years 1 and 2, we expensed more than in the straight line, and now in years 3 and beyond, we're going to be depreciating less. Over the life of the asset, we can only expense $24,000, which is going to leave us with a salvage value of $6,000. So we have to make up that difference at some point. Now, year 4 presents an interesting problem for us. We have a beginning net book value of $64.80, and if we multiply it by 40%, we get $25.92. We aren't going to expense $25.92, though. Why not? Because if we did so, we'd go over our cap. We know that we can't depreciate more than $24,000, so in year 4, we'll actually just plug our depreciation expense to be $480, since that's as far as we can go. That'll give us a net book value at the end of year 4 of being $6,000. And in year 5, we'll actually have no depreciation whatsoever, since we're already at our $24,000 limit. We'll have $6,000 of book value right there. So now, why did I pick these two to focus on? Well, those are the ones most people use. Straight line because it's easy, and double declining balance because a good chunk of tax depreciation is based on some permutation of the declining balance system. Ultimately, what's happening? We need to get to here, and we need to get to here. We need to expense a total of $24,000. And so long as it's systematic and rational, we're good. There is a third method to look at briefly, and that's the activity method. If we wanted to do perfect matching, this would be the way to do it, because what we're going to do is depreciate the asset on a straight line basis, but rather than straight line over time, we're going to do it straight line over activity. Hours of production used, miles driven, that sort of thing. Or for this particular example, number of donut holes produced. Using the same numbers as before, we're now going to use the donut hole machine for 100,000 units rather than 5 years. We'll calculate our depreciable base and divide it by total activity to get a per unit cost, and then multiply that per unit cost by the activity we do in 1 year. So here we've got 30,000 minus 6,000 is equal to our $24,000 depreciable base, divided by 100,000 units, and that gives us 24 cents per donut hole. If we've made 30,000 units in the year 1, then we're looking at 30,000 times 24 cents. We're looking at $7,200 of depreciation expense in year 2. Our 20,000 units in year 2 is going to translate to $4,800 of depreciation expense, and so on. When all is said and done, these are going to sum to that same $24,000 and an ending net book value of 6. All we do is change the timing as we change our depreciation method. So a couple last points on depreciation. First of all, look back a slide and note that in year 5, under the double declining balance method, we had no depreciation expense, and that's okay. As it happens, the longest period over which we're allowed to depreciate an asset is 50 years, no matter how long we expect that asset to be used. So if we think about the buildings around campus here, there are probably several of them with book values of 0 and annual depreciation expense of 0 because they're older than 50 years. Does that mean those buildings are worthless? Of course not. Well, Neville Hall is. It's kind of a slum. But otherwise, no. No more so than the donut hole machine could have been sold for $25,200 after year 1, or $20,400 after year 2, or $18,000 after year 1, or $10,800 after year 2. Remember the purpose of depreciation, allocation of cost into the income statement. Nowhere in the definition is anything about tracking asset values. The $25,200 or the $18,000 is simply the amount of asset cost that hasn't yet been expensed under those two methods. Nothing more. The second thing has to do with this salvage value thing. Salvage value is a tricky concept because if we're looking out 5 years from now, how much do we really expect someone to pay us for that asset? With what certainty can we predict that? Not a whole lot. If we come back to our example of budget rent-a-car, that's probably a good candidate for salvage. Their business model involves renting a car for a period of time and then selling it on the used car market, and I'd be willing to bet that by this point they've got a pretty good idea as to what they can sell that Taurus for in 18 months when it comes out of the rental fleet. For most businesses, though, I would tend to shy away from salvage as an unpredictable number. Lastly, we do live up here in Maine, and one of the things we do up here is cut down trees. When we buy a forest with the plan on timbering it, we capitalize that asset just like we bought a building or a truck or a donut hole machine. Rather than depreciating the forest, we'll use the term depletion, though the process is identical to the activity method. We will estimate how many board feet we plan on extracting, and then as the trees are cut down and processed, we'll recognize a proportionate share. The big difference is that we aren't going to deplete this into the income statement. What we're going to do is deplete this into inventory. Our journal entry will still credit accumulated depletion, but the debit will go into raw material inventory. Why? Because this is a cost of producing inventory, and therefore it should be included in inventory and expensed as cost of goods sold only when the products are sold. So we've bought the asset, we've used the asset, now it's time to dispose of the asset. It's going to happen sooner or later. Perhaps we'll be able to sell it to someone if there was a salvage value. Perhaps it was a hunk of junk and we tossed it into the dumpster. Perhaps it was a computer with sensitive data and we actually had to pay someone to do a secure destruction of all the files. We have a very methodical stepwise procedure that gets us where we want to be. Step 1 is, of course, to steal underpants. Step 2, Step 3 is profit. Okay. So, Step 1 is that we depreciate the asset to the date of disposal. That allows us to make sure that we've got the proper amount of depreciation being recorded on the income statement, or more importantly, being recorded as a component of inventory. Step step 2 is to get rid of the asset from the books with a credit. Here's our asset T account, and it's got a debit balance over here. We credit it for an equal amount, and now the account has been zeroed out. We know that if we don't have an asset, having accumulated depreciation doesn't make any sense, so the accumulated depreciation for this particular asset must be eliminated as well. Accumulated depreciation carries a credit balance, so we will debit it down to 0. Step 4 will be to recognize cash, whether we are the ones being paid or we are the ones paying, and then if our journal entry doesn't balance, we will plug to a gain or to a loss. So let's take a look at an example of an asset that originally cost us $10,000, and we'll run it through a couple of scenarios. Let's say first it's been fully depreciated and we throw it in the dumpster. Well, assuming step 1 was done, we move on to step 2 and we credit the asset for $10,000. It was fully depreciated, so accumulated depreciation would be $10,000 as well, and we have to zero that out with a debit. We tossed it in the dumpster, so there's no cash changing hands, and our journal entry balances, so we don't need to recognize a gain or a loss. What happens when the assets have not been fully depreciated? Let's say we've only depreciated $8,000 by the date of dumpsterization, which is of course a word that I made up and absolutely rocks. In fact, a Bulgarian student of mine told me she was going to go back home and spread the gospel of dumpsterization because it's such a cool word. And you heard it first here. So the asset only had $8,000 of accumulated depreciation. What does that do? Well, we're still going to credit the asset for 10. We're going to debit accumulated depreciation for 8. No! Our journal entry doesn't balance. We've got too much credit and not enough debit. Well, what happened here? Our balance sheet says that we had an asset that was worth $2,000. Was it really worth $2,000? No, but our books say it was. And what did we get for it? Nothing. So from an accounting perspective, we just had a boo-hoo on the order of $2,000. We've got to recognize a loss. Once again, we can see that the value of the long-term asset on the balance sheet does not necessarily translate into actual market value. Let's introduce some cash. We're in the same place as before with the $8,000 in accumulated depreciation, but now we're going to sell the asset for cash. We credit the asset, we debit the accumulated depreciation, and we recognize the fact that we received $1,000 in cash. Our journal entry still doesn't balance, but at least we're a little closer. Our loss is only for $1,000. Lastly, let's receive $3,000 in cash. We get rid of the asset and the accumulated depreciation, we recognize the cash, and now we find ourselves in a gain situation. One more thing to look at for this. Let's go back to our donut hole machine that we were depreciating just a little bit ago. Let's say at the end of year 3, we sold it for 10 grand. Now go back and look at the calculations we did if you're so inclined. What we end up recording for a journal entry is quite a bit different depending on which method we used. Let's start with the straight line method. We credit our asset for 30 like we always do. If we have no asset, we can have no depreciation, and so we'll debit our accumulated depreciation for $14,004, and that's 3 years at $4,800 per year. We recognize the cash that we received, $10,000, and our journal entry doesn't balance. What are we missing? We're missing a loss for $5,600. Let's look at this same situation in which we sold the asset after 3 years for $10,000, but this time we're going to use the double declining balance method. We'll credit the machine for $30,000. Our accumulated depreciation after 3 years was significantly higher because we used an accelerated depreciation method, and we found ourselves with $23,520 of accumulated depreciation on the books. We recognize the cash for $10,000, and we still need to plug, but this time the plug is going to go over here to the credit side, and this time for a gain. So what I want you to think about now is what's going on here. We bought an asset for 30 and we sold it for 10. Those are statements of fact. Do we have a gain here? Do we have a loss here? Well, if we chose to keep the books using the straight line method, our accountant says that we have a loss. If we chose to keep the books using the double declining balance method, then our accountant says we've got a gain. What gives? Well, what gives is that we have to remember what the goal of depreciation is. The depreciation process takes the cost of the asset and gets it into the income statement. We originally expected to sell the asset for $6,000 after 5 years, but with the benefit of hindsight, we know that the true cost of the asset to the firm was $20,000, the 30 minus the 10. So do we have an economic gain or an economic loss from this disposal? No. What we have with this disposal is a true-up between what we recognized as an expense through depreciation over the 3-year period and what the asset actually cost us, $20,000. If we had perfect foresight, we would have depreciated exactly $20,000 over the 3-year window. We didn't have perfect foresight, so we play catch-up now when we make the sale. We're out $20,000 over the life of the asset, but we only depreciated $14,400 under the straight-line method. So what do? We book another $5,600 to the income statement. There's our true-up. $14,400 plus the $5,600, there's our $20,000 of true cost. Similarly, we are out $20,000, but down here we depreciated too much. We depreciated $23,520, and we should have only depreciated $20,000. So what do? Once again, we're going to true up, and we have that same $20,000. We bring it back into the income as a gain. One last thing to talk about related to fixed assets before we move on to intangibles. What happens when we spend money on an asset after the asset has been purchased? We were allowed to capitalize costs before the asset started generating revenues, but now what? And there are going to be costs that we incur on our assets, from having someone come with a snowplow to putting a new roof on the building. And what do we do with that subsequent payment? The way that we're going to look at this is by distinguishing between whether the cost is for maintenance or if it's what we call a betterment. I've made up words before, but I promise I didn't come up with that one. That is the worst word ever. But that's the word. We're making the asset better. So of course our first question relates to whether or not the cost is material. Is it going to make a difference to a decision maker if this particular dollar value is misclassified? If it isn't, then just expense it right away. If it is material, then we have to look at what the expenditure does. An expenditure is considered a betterment if it meets one of the 4 following criteria. Has it increased the asset's useful life, increased production quantity, increased production quality, or decreased costs to operate? In each of these cases, the original logic behind capitalization still stands. We're going to be benefiting from this cost for multiple periods. We should capitalize. If this is the case, then we will account for this the same way we booked the original asset, recording this journal entry right down here, debit to asset and credit to cash. If, on the other hand, the expenditure doesn't meet one of those 4 criteria, then we say this is just routine maintenance, and we expense it in the current period's income statement. Now you might think that there's a certain amount of gray area here, and there's a lot less than you might expect. I know what you're thinking. Well, Dave, if I never change the oil in my car, its expected life isn't terribly long. Or at least that's what the guy at Jiffy Lube says. So when I change my oil, I'm therefore increasing the asset's useful life. Does that count? Or perhaps I just had a flat tire, and a car with a flat tire has a useful life of pretty much 0. So getting that tire fixed is extending its useful life. Does that count? No, and no. If the money is spent to keep the asset running in the way it was originally designed, then no, that's not a betterment. We gotta book the expense. And you might recall that whole MCI WorldCom thing. They started out as MCI, then they became MCI WorldCom. Then they said, let's get rid of the MCI and let's just call ourselves WorldCom. And then they committed fraud and went bankrupt, and now they're back to MCI again. And what was it they did? Well, part of what they did was they spent money on their fiber optic lines and recorded this over here when they should have been recording this over here. And we're talking $4 billion, so this isn't chicken scratch. So when this unraveled due to a whistleblower, they had to announce to the world, oh, remember how we earned money last year? Yeah, well, we didn't really. Oh, and the year before that? Nope, not then either. Year before that? As you can imagine, that went over very poorly with investors. And some folks went to jail, and that's never a pleasant experience. So let's try not to game this stuff. Let's do an example. It's Mainco Pizza, which serves the greater Orono region, and they just bought a giant pizza oven for $5,000. The oven was going to last them 4 years, and then over that time they spent some money on it. Let's go through the life of this asset and see what we can see. First of all, of course, those $50 per year service doesn't make the asset any better. All it does is keep the asset in its current productive capacity, which means that we're going to charge this to maintenance expense. We're going to debit the expense, and we're going to credit cash. We're going to do the same thing with that conveyor repair. Of course, with a broken conveyor, the oven's life is 0, and repairing it makes the life non-zero, but we know that that doesn't count, because that's just getting us back to where we were before it broke. So that will get charged to our maintenance expense as well. It's starting in year 3, when we install that new heating coil, that we're extending the asset's useful life. So when we spend that money, when we credit that cash, we're going to debit the asset. Now, what do we debit specifically? Well, depending on the book you're reading, you've got a couple of choices. First, we could debit the giant pizza oven. That would be my preference. Some books suggest instead that you should debit accumulated depreciation. I don't particularly like that, but the net balance sheet effect is the same. We're just changing the account that the money goes into. A third option, if the expenditure were significant enough and were separable from the underlying asset, would be to give it its own brand new account. So say, for instance, that the air conditioning units in DPC die and need to be replaced for $50,000. That's a significant amount of money, and the AC units could be considered separate enough from the underlying building that they would get their own asset accounts. Our last expenditure is a reinstall, and even though we're not physically adding to the asset itself, the reinstallation will yield significant decreased costs over time, and so we will consider that to be a betterment anyway, and capitalize the expenditure just as we did with the heating coil. So now we've got a little worksheet that we can fill out that will allow us to see how these expenditures of both types make their way into the financial statements. Back in 1998, we bought the asset for $5,000. The $50 that we spent on maintenance goes straight to the income statement as an expense, and our depreciation expense will be based upon our asset cost and its useful life. So we've got a 4-year useful life and a $5,000 cost. Our depreciation expense will be $5,000 divided by 4, or $1,250 of depreciation, leaving us with a net book value of $3,750, and that's what we will say on the balance sheet. That $3,750 carries forward to 1999. The $300 we spent on the repair is not an increase in the value of the asset, so we will add that to the annual service and we'll have a total of $350 of expense on the income statement. Our depreciation is the same. We're using the straight line method, and that's the point. And so we will be left with a net book value of $2,500 at the end of year 2. It's in year 3 that things start to get complicated. We begin the year with the $2,500 net book value, and then we drop some money on the heating coil. That $1,500 we spent extended the asset's useful life, and we called that a betterment. So one way or another, we increased the net book value of the asset from $2,500 to $4,000. We now need to redo our depreciation calculation. We've got $4,000 here tied up in the asset of undepreciated cost, and we have extended its useful life. It's going to last for 1, 2, 3, 4 more years. So our depreciation expense is going to be calculated as the $4,000 of undepreciated cost divided by the remaining useful life of 4. Our depreciation expense for year 2000 is going to be $1,000. That'll give us a net book value of $3,000, and of course we've got those $50 expenditures each year that show up as expenses. Note that we didn't do anything retroactively to those first 2 years' depreciation expense. This is a change in estimate, which means we simply go forward from where we are, letting what happened in the past stay in the past, kind of like Vegas. In 2001, year 4, we start the year with $3,000 of net book value. We depreciate it for $1,000, leaving us with $2,000. And then we spend some money on the reinstall in 2002. We spent $400 on the reinstallation. We're going to treat this the same way as we treated the coil. That cost is now added to the book value of the asset, and we now have $2,400 of asset value that needs to be depreciated over 2 years. So this gives us $1,200 of depreciation expense in year 2002, giving us $1,200 of book value, and we've got $1,200 of depreciation expense in 2003, and now we have a net book value of 0. We have now fully depreciated the asset. So to recap, depending on whether the expenditure makes the asset better or not, we will either expense it in the current period as maintenance, or we will capitalize it and depreciate it over the asset's remaining life. In this case, we treated the $1,500 in 2000 and the $400 in 2002 the same way that we treated the original $5,000 purchase. So now let's turn to intangible assets, our last big topic for the day. What is an intangible asset? Well, first of all, of course, it's an asset. But in addition to that, there are two key characteristics that make an asset intangible. First, it doesn't have physical substance. It's not a desk or a computer or a truck or a forest. Second, it's not a financial instrument. So when we talk about intangible assets, we're not talking about cash, investments, or receivables, or derivatives, or any of that stuff. We're still talking about long-term productive assets. They're just productive in a different way than are our physical assets. So how do we assign value to these assets? At what dollar value do we put them on our balance sheets? Well, it depends on where we got them. Internally generated assets, those assets we have created ourselves through R&D or through other creative means, they have their costs expensed as they're incurred. That is, we record R&D expense instead of R&D asset. If we're Disney and we're making a movie, we expense the animators' salaries even though we will copyright the movie and generate revenues over a long period of time. The exception to this rule is that legal costs associated with the filings for protection or legal fees associated with defending our patent can indeed be capitalized. The reality, though, is that the bulk of the money we spend will be expensed as incurred. As I mentioned in Chapter 2, this is due to conservatism. The other option is for intangible assets that were purchased from another entity. For instance, say we're Merck, and we just bought the rights to produce some drug or another from another biotech firm. In this case, we've got a triggering transaction, and we've got an observable market price for the transfer. We will therefore treat this exactly like our regular assets. We will capitalize that initial cost by debiting patent or whatever, and then depreciate it over its useful life. We'll use the term amortize, but we're still doing the same thing. So now there are three broad classifications of intangible assets, and the way we account for each is different. The first is the finite-lived intangible. These are the ones that have specific lives, either contractual or legal. These are your patents and your copyrights, since after they run out, anyone in the world can produce them without our permission. There are other things we can call intangible assets, though. One of my former clients was a vending machine company, and the way they expanded was by buying up other vending machine companies in markets they wanted access to. And while most of the purchase price related to the trucks and the machines and the Snickers bars, they also received a couple other important assets. First was an agreement by the sellers that they wouldn't sell Snickers bars in the general vicinity for a period of time, perhaps 3 years. That's a non-compete agreement. This kept them from just going out and buying all new trucks and picking up the delivery schedule they'd been doing for years. That protects us, the buyer, from shenanigans. The other was the customer list. It's one thing to have a bunch of trucks and Snickers bars and stuff. It's something else entirely to know where to deliver them and who likes what sorts of foods in their machines. And if you think about it, that's what the selling entrepreneurs spent their careers doing, establishing relationships and learning their customers' preferences. Do these things count as assets? Of course they do. That customer list will generate revenues from those clients, and that non-compete agreement gives us a virtual monopoly for long enough to establish our own client relationships. If the other folks want to come back into the market, they'll have to start from scratch since their old customers will now be ours. These types of assets, the intangible assets with finite lives, are treated exactly like our tangible assets, keeping in mind the caveat about internally generated versus purchased. We'll amortize that cost into the income statement over its useful life. The next class of intangible assets is made up of those that don't have a specific horizon to them. These are our trademarks and trade names that will continue to have value for as long as we continue to maintain them. That Coca-Cola swoopy lettering, the McDonald's arches, Hello Kitty. These will generate future revenues. These were all internally generated, so they don't likely have much, if anything, in terms of book value. But if we had purchased them from another company, they would absolutely be on the books as assets. Once they're on our books, there's no reason for any of those assets to ever lose their value so long as customers continue to recognize it and buy our product. These intangibles are like land. They are eternal, and we'll leave them on the books until we have reason to take them off. Our last intangible asset is goodwill, which is in a category of its own. What is goodwill? Well, we can define goodwill as the excess of purchase price over the fair value of purchased assets. This is an important point. The only time that goodwill will ever be recognized on the books of a company is with a corporate acquisition. Goodwill comes about because when we list out all the assets, tangible and intangible, that we got when we purchased this other company, we can't explain the full purchase price. We paid more than that collection of assets we received is worth. Now, this leads to the next question. Gee, Dave, why would you do something like that? And that leads us to the economic rationale behind goodwill. Why pay more than the assets are worth? And the answer is that we think that for some reason or another, we can generate greater profits from this bundle of assets than might normally be expected. Buying this bundle of assets will yield a higher return than if we purchased comparable assets individually. Now, the example that I like to use once again involves donuts. Dunkin' Donuts in particular. If you're familiar with the Orono Old Town region, you know that there are two Dunkin' Donuts along Stillwater Avenue. One is over by the elementary school in Old Town, and one is near the exit from the freeway. And what is a Dunkin' Donuts? It's a building with some toasters and coffee makers and tables and not a whole lot else. Let's assume for a moment that the two facilities are identical, that they're both equally new and shiny, and that they have the same equipment inside. Let's also assume for a moment that neither owns the land. They are leasing it from a third party. Given that information, would you expect to pay more for the location in town or the one between the freeway and the university? It would seem to me that the one near the freeway is going to generate far more sales and far more profits than the one down by the elementary school, even though in both cases you are getting the exact same bundle of assets. That extra amount we purchase is goodwill. Really quickly, let's take a look at a journal entry to record the purchase of one company by another, just so we can all be clear on what this goodwill thing is. Purple, the parent, buys Salad, the subsidiary, and absorbs all its assets into its own books. Now, what does Purple get when they buy Salad? They get all of this stuff over here, right? The cash in the registers, and the bank accounts, the receivables, the property, and it assumes the liabilities. Let's book the journal entry required to get all this stuff onto the parent's books. We got the cash. We got the receivables. We got the property. And we assumed the liabilities. So there we have recording everything we've gotten from this purchase. And when we look at this, it appears that we're getting $65,000 in assets. We are assuming $15,000 in liabilities. So we are getting net assets of $50,000. And what did we pay for it? We paid $75,000. So our journal entry doesn't balance. Crap! None of those numbers are fudgeable, so we need to come up with another $25,000 of debit somehow. And voila, we wave our magic wand and we get goodwill. Goodwill is not amortized, it just sits on the books forever, like land. So again, it's important for us to recognize what this is. When we see something on the balance sheet that says goodwill, what does that mean? Well, it means that we paid a whole big bunch of money above and beyond what the acquired assets were worth, and we needed to plug a debit to make the entry balance. Does it mean we overpaid? Not necessarily. But can we sell that asset for cash the way we could sell a patent? Absolutely not. And just as with all our assets, each year we need to assess whether or not that asset value still exists. whether the potential to earn those abnormal returns is still there or not. And if it isn't, we have to write it off in the current period net income, just like with lower of cost or market on our inventory. Perhaps you remember the merger between AOL and Time Warner back near the end of the last century. Wow, that sounds really long ago. Anyway, the idea was that Time Warner was content production and AOL was content delivery, and together they would be able to rule the entertainment world. So Time Warner purchased AOL by issuing around $110 billion in stock, give or take, in what was then one of the largest corporate mergers ever. Now, what did AOL have? They had a bunch of computers, they had some office space and such, and they had warehouses full of those disks with which they used to bombard our mailboxes. So when they recorded the purchase, they put $100 billion into goodwill just to make the journal entry balance. And what's the company called now? Just Time Warner. Which suggests that that AOL thing didn't quite work out. And when they realized it wasn't going to work out, what did they do? They wrote off $50 billion of goodwill. Oops, that's one ugly journal entry. And then the next quarter, they realized they hadn't written off enough yet, so they wrote off another $49 billion of goodwill. Oops, that's another ugly journal entry. So keep an eye on that goodwill thing. It's a tricky subject. So there we have our long-term operational assets from birth to death. Ultimately, it can all boil down to one thing: matching. Costs we incur today will generate revenues in future periods, so we defer those costs, expensing them over time.